Hello people, hope you're all doing good. So in this particular session, we'll be doing Advanced Accounting RTP for May 2026 exams. So overall, how is this RTP? It's a pretty easy, except maybe one question I would say specifically is nicely designed. Another 2-3 new questions are there. Other than that, everything is rinse and repeat. Okay, right. But yeah, other than that one question, I think more or less everything you can manage. Okay. But the first thing is when you look at this RTP, you will see a lot of amendments. Okay, so this is not current amendment. This is not latest amendment. This amendment already came previously. It's the same amendment. They've copy pasted it. Yes, this is the same video as amendment video. I've also uploaded on YouTube as well, and it's available in our course. Right, so you can refer that. There's nothing. It's application of accounting standard wala amendment. It came 1 year back. No, same thing they've copied. One more they've said over here. Okay, but that I feel is not required. Just here, no people, just remember one line for exam, that is good enough. There is no DTA detail required for pillar to income tax. Basically, due to pillar to income tax, if you're getting any DTA detail, no need to create DTA detail for such component. Okay, that's all as a one-liner. I don't think so this will be tested much. If you just want to know what it is, now, what is this pillar 2 taxation is? One committee called OECD. It's given over here. Okay, the OECD committee rather, right? They introduced this particular something called top-up tax or minimum top-up tax to be met globally. What is this over here? Let's take a small example if you want. Let's say there is one company X Limited. They are an Indian company. They are parent company or there is holding company. Okay, so holding company or parent company is there in India. They have a subsidiary, but the subsidiary is a foreign company. Now, people, in India, we know that the tax rate is 30% plus surcharges there, cess is there and whatnot. Let's say the subsidiary company, which is in a foreign country, they have to pay tax only at 5% rate assumption. In that foreign country, tax rate is only 50%. That means now what? Parent company, man mein laddu futa. Parent company got one idea. What is that? You have to pay 30 plus tax rate in India, but my subsidiary has to pay only 5%. Correct? So hence parent company may route majority of the transaction through subsidiary. Because if parent gets any income, they have to pay tax at the rate of 30 plus. But if the same income is accounted through subsidiary, then the tax is only 5%. Hence parent can route some of this transaction through subsidiary to save tax, which was actually happening. Hence this OECD community globally, they formed and they said, no, this is unfair. Okay, many companies are taking advantage of this. Hence they said, though you are in a foreign country, if you have a parent and routing transactions, you have to pay minimum tax at what rate? 12%. So this is assumed rate. This will vary. You might study in your CA final tax, right? Let's say minimum global tax is 12%, assumed rate. Both this and this are assumed rate. Okay. Now, normally in this foreign country, when you are operating, you have to pay tax at what rate? 5%. But since you have a parent and you're doing some transaction, now the subsidiary will not pay tax at 5%. They'll have to pay it at 12%. Instead of 5, they'll have to pay it at 12%. That means, are they paying any extra? 12% minus 5%. How much extra? 7% extra they're paying. Now that we call it as top-up tax. Now, since you're paying extra tax, due to that, some DTA DTL consequence may arise. From deferred tax asset, deferred tax liability may arise. Relating to this, if you're getting any DTA DTA, that need not be accounted is what the clarification or amendment is all about. Theoretical amendment. Okay. If at all they give, maybe 1 marker or 2 marker ka theory question can be asked. That's all. So just remember one final point. No DTA DTL is required for pillar 2 income tax wala provisions. That's one. Okay. Rest all same. Now, in this particular RTP, we'll be running through the new questions as I told. Okay, first let's run through the first case-based question. It's a simple question, in fact, faltu question. Company purchased the land from its own funds and started construction of 2 towers. Land they purchased from their own funds. They did not take any land loan for this. For purchasing the land, the company has not taken any loan. And first of all, land is not a qualifying asset. It is ready to use. No. On this land now, tower is being constructed. The business park example, which we used to give in our class. Okay, a building is being constructed. Not one building, 2 towers or 2 buildings is being constructed. The company for construction for this tower construction purpose, they borrowed 60 lakh loan each. The company for the construction borrowed funds of 60 lakh each for both the tower. So for tower 1, they borrowed 60 lakh. For tower 2, they borrowed 60 lakh. Totally 1 crore 20 lakhs is borrowed. Company is required to pay interest of 60,000 annually for each loan. For one loan, 60,000. For 2 loans, 1,20,000. During the first year, company allotted the vacant area for parking purpose. Land was vacant, no? So they let it out and earned a revenue of 15,000. Now what we will do, we have learnt in our borrowing cost. So any temporary investment income we need to reduce, sir. Yes, temporary investment income we need to reduce. But what does temporary investment income mean? Sir, when you take a loan, okay, you will not utilize that loan in one shot. You will utilize it in stages. So instead of keeping that loan money idle, if we invest and earn some income, that we call it as temporary investment income. Here, loan money we invested and earned the rental. No, land which was vacant, we let it out as parking space and earn the income. I mean, this is not temporary investment income out of a loan. This is from a land. So this is not temporary investment income, which we will reduce for borrowing cost purpose. Got it? So this is one good adjustment. So you should not minus this. Okay. All right. The tower 1 is ready to use by the end of second year. We know people capitalization stops once the asset is ready to use. Correct. No? So tower 1 is ready by second year. So tower 1 related borrowing cost you can capitalize for first year, second year. Second year it stops. What about tower 2? No information. So construction is still going on. The company capitalized the same and started using the same for intended purpose. Okay, now the question. How much borrowing cost should be charged to P&L for year 1? Year 1 nothing. Why? Sir, basic information I've given you over here. You took a loan for tower 1 60, tower 2 also 60 lakh. Interest is 60 for both. RTU means ready to use. Tower 1 is ready to use by second year. Tower 2, when it is ready to use, not given. It is still under construction. Okay, that means what? Relating to tower 1, you will stop capitalization in year 2. Tower 2 capitalization will continue because they have not given the ending date. Till the ending stage is reached, we'll go on capitalizing for tower 2. But tower 1, the stopping capitalization stops at year 2. Here they're asking for first year, how much will you charge to P&L? First year, nothing will be charged. Both the borrowing costs will get capitalized. So answer is nil. How much borrowing cost will you capitalize for first year? For tower 1 60, for tower 2 60. So total 120 will get capitalized. Now they said how much borrowing cost will go to P&L for third year. So relating to tower 1, capitalization stops at year 2. So third year ka borrowing cost relating to tower 1 of 60 will be going to P&L. So 60,000 will go off to P&L. Now they are saying how much borrowing cost will be capitalized in year 3. Tower 3 is still under construction. No? So tower 3 ka borrowing cost 60,000 will be capitalized. So A for alpha. Good question. Okay, simple question, good one, but don't do any adjustment for this 15,000. That's the takeaway of this case study. Okay, because this is not a temporary investment income out of the loan. Land we let out and earned income out of this. So that is not temporary income to be adjusted. Okay. Now this case, this is a good case actually, right? Okay, but I feel for a 2 marker, this is not at all a number to be asked. People, this is more like a minimum 5 marker question. Okay, so you will see why. Okay, so pakka this is a minimum 5 marker question. I don't know why I say put it as a 2 marker MCQ here. Very too much to digest. Easy only, but we need to do a couple of working notes. Check. Suraj is the lessee. They acquire machinery on lease from Chand Limited on 1st April 2025 for 3 years. Lease term is 3 years. Life of the machinery is also 3 years. That means pakka finance lease. Agree? Because one of the characteristic of finance lease is what? Finance lease, we have 5 characteristics. Present value of minimum lease payment approximates fair value of the asset. Useful life, lease term approximates useful life of the asset. Asset is transferred to the lessee at the end of the lease term. Or lessee has an option to buy the asset at a value significantly lower than fair value. Or it's a customized asset. Or a customized asset where only lessee can use it without making major modification. A specialized asset we say. Correct? No? These are the 5 conditions. If any of the 5 conditions are satisfied, it is a finance lease. If all 5 fails, then it is a operating lease. Here lease term is 3 years, life is also 3 years. So for 100% of the duration, lessee is only going to use. Right? So pakka it's a finance lease. Okay. In finance lease, lessee has to record the asset. We know this. The fair value of the asset is given to be 250 because lessee will record the asset at present value of minimum lease payment or fair value of the asset, whichever is lower. For that, they have given fair value. Okay. The guaranteed residual value is 2,000. Lessee has given a guarantee to the lessor for 2,000. Fair enough. As per the lease agreement, lessee is required to pay 1 lakh per year from 1st April 2025. Okay. Lease starts on 1st April. No. So that means lease payment is not done on 1st April. They're saying since you have entered into a lease agreement on 1st April, lease payments also will start accruing from that day. Lease payments you will make it at the end of the year only. Right? Lease starts accruing lease becomes, lease will start accruing from the lease agreement date, which is 1st April. Lease payments are still made at the end of the year only. Okay. Lessor has a guaranteed residual value of 20,000. Hey, this is confusion. No? Here they told guaranteed residual value 2,000. Here GRV is 20,000. What does that mean? Sir, it's possible that lessee and lessor can have different guaranteed residual value. Once again, it is possible that the lessee and the lessor can have different GRVs. Okay. And how much GRV lessee gave to the lessor? 2,000. So whenever you do lessee ka calculation, you will take GRV to be 2,000. Whenever you do lessor ka calculation, you will take GRV 20,000. Why, sir? Because lessor ka GRV is 20,000. Because lessor, no, people can get guarantee from lessee also, from third party also. Possible, no? Lessee, the lessor rather, the owner of the asset can take the guarantee from lessee also. He can take the guarantee from a third party also, right? That possible. That because lessor might tell the third party, I will sell you the asset. Give me a guarantee or give me the price. So hence, lessor can take the guarantee from the lessee as well as third party. So hence, lessor and lessee ka guaranteed residual value can be same. It may not be same also. So whenever you're doing lessee ka calculation, GRV is 2,000 here. Whenever you do calculation from lessor angle, it is 20,000 here. Lessor estimates that its value is 5,000. Estimated value is irrelevant. We want the total guaranteed residual value. How much is that? 20,000 for lessor, 2,000 for lessee. That's pretty much it. Now, at what value machinery should be recognized? So, lessee will recognize the machinery at present value of minimum lease payment or fair value of the asset, whichever is lower. But to find out present value, we need discount factor. Here, discount factor only was missing. If they had given discount factor, acceptable. We can do it as a 2-marker question. But when discount factor is missing, I had told you first priority for discount factor is always IRR. If IRR is missing, then we will take incremental borrowing rate for the lessee. Here, incremental borrowing rate also missing. IRR also missing. That means what? First, we need to find IRR. We need to calculate IRR. We have done this in FM, interpolation formula. Remember, we have to use that and get the IRR, right? We have to assume two rates. Basically, IRR is a rate at which present value of cash inflow and present value of cash outflow are same. In fact, in AS 19 also we had said IRR is basically a rate at which present value of lease rental plus present value of GRV plus present value of UGRV will be equal to fair value of the asset. Yes. No, these three ka present value will be equal to fair value. Fair value is given. So these three ka present value will be equal to fair value at what rate? That rate is your IRR. That is not given to us in the question. We have to find it out. And how do we find IRR? Is we have to assume two random rates we have to assume and use the interpolation formula. First, I've taken 10 and I've taken 14. You can take 8, 14. You can take 6, 13. Any rate, your choice. Fine. So what do you have to do? Outflow and inflow ka present value. Basically, these ka present value you need to find out here. That's all it is. Okay. Now, fair value. At year 0, fair value is asset ka value now. No. What is asset ka value now? 2,50,000. Now, if lessor is the owner of the asset, if owner has to buy the asset, means how much he needs to pay? 2,50,000. At year 0, the value will be 2,50,000 negative. You put the sign from the lesser angle. Because IRR is from lesser angle. Okay. For year 0, discount factor is always 1. Then 3 years, lessor is going to receive lease rentals. How much lease rental? Lease rental is 1 lakh rupees. It's the same amount. No, when the amount is same every year, we can use PVAF. There's an inflow, so positive number. Okay, so or one way is, sorry, these numbers for lessor, these numbers are positive inflows. No, I mean this automatically becomes like an outflow because fair value of the asset means value of the asset. If lessor has to buy the asset, he has to pay this much money and buy. Hence, we interpret fair value as a negative number here. Lease rental is 1 lakh every year. It's the same. So we will use PVAF, present value annuity factor. 1 divided by, how do you get discount factor? 1 divided by 1 plus I whole power n. We have done this in every lease question, right? So you do 1 divided by 1.1, press equals to button 3 times and then press GT button, grand total button, you will get this. Okay. Then present value of GRV. We are doing IRR from lesser angle. Don't forget that. This is from whose angle? Lesser. From lesser angle, GRV is not 2,000. It is 20,000. Okay. 20,000 lesser will get every year. No, only once. Which year? Third year. Hence, third year ka take PVIF, present value interest factor. 1 divided by 1.1, press equals to button 3 times. So you'll get this number. Then UGRV not there, so 0. If it was there, we would have taken that also. So this ka present value you find. Now people, if this 10% is IRR, mean this is inflow ka present value, this is outflow ka. I mean, this should become 0. When you add all this, if it becomes 0, then that is the IRR rate. That is a discount factor. Here, are you getting? No, you're getting positive number. Now we have to assume one more rate. So this number we have to reduce, because basically it has to become 0. From 13,620, it has to become 0. If this number, if you want to reduce, means interest discount factor, we will increase. If you increase the discount factor, this number we will reduce. This only in FM terminology, we used to call it as NPV. Okay. Now I want to test it at 14%. At 14%, take this the cash flow, this is the discount factor. Multiply, you'll get the answer. It is negative. It is negative you're getting. That means 14% is also not your IRR. Because if 14% was IRR, means this number should have become 0. But it is negative. So IRR is somewhere between 10 and 14. Somewhere between 10 and 14. Now use your FMK interpolation formula. IRR is equal to lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Lower rate among 10 and 14, the lower rate is 10%. So I've taken that. At 10%, the NPV. NPV means the final number, which is what? 13,620. Divided by NPV at lower rate minus NPV at higher rate. Higher rate is 14%. At 14%, NPV was negative. So it's already negative and we need to minus. Minus or minus will become positive. Into higher rate minus lower rate. 14 minus 10. Solve, you will get 13.03%. That is your discount factor. If this was given to us in the question, then accepting it for 2 marks is fine. Now you are asking us to find IRR also, and then you are asking us to record the asset value. That is too much for 2 marker. It will take a lot of time. Okay. Now we found IRR or a discount factor. This we need it. Now what is the requirement of the question? They said at what value machinery will be recognized. Since it's a finance lease, lessee will have to recognize the asset. Since it's a finance lease, lessee will have to recognize the asset. At what value? Present value of minimum lease payment or fair value of the asset, whichever is lower. Now we are doing the calculations from the lessee angle. Don't forget that. Okay. Now we have to find present value of minimum lease payment. What and all payment lessee is making? 1 lakh every year for 3 years. And third year in May GRV. Now don't take 20,000. We are doing calculation from lessee. As far as lessee is concerned, guaranteed residual value is 2,000. This will come in third year. This will come every year. So we are using PVAF. This will come only once. So PVIF. Discount factor is 13.303% as we have taken here. Okay, people. So can I round off and take 13%? If I check the option, no, they have given approx, and all. Okay, so exact number will not match. Hence, I have not rounded off and taken it as 13. I have taken 13.03% only. Exact number I have taken it as discount factor. Okay, then when you do it, you will get present value of minimum lease payment is 2,37,385. So let's see, we'll record the asset at present value of minimum lease payment or fair value of the asset. What is the fair value of the asset given in the question? 250, whichever is lower. The lower number among this is 237,385. Now, exact number may not match because this is not 13.03. There are more decimals. We stopped at 2, right? Look for the closest option. 237,385. 237,385 is closest to 237,400. Hence, C for Chennai is the right answer. Okay. So that way I feel this is definitely not a 2-marker question because IRR was missing. Discount factor was missing. But if discount factor is given, it's an easy question. 2-marker acceptable. Okay. That way, yeah, this question is an LDR one way. How to find IRR? We anyway done it in almost many chapters of FM, but here also we have taken you through that. Done, people? That's all. Next is which is not an example of cash and cash equivalent, they're asking. Balance in the unpaid dividend account. Now, people, if you are not paid the dividend to shareholder, you have to keep that money in a separate bank account. That is also cash and cash equivalent only. Earmark the bank balance for specific purpose, like bank account for debenture redemption, dividend payment. Now, for a specific payment, if you opened a bank account and if the payment is not yet done, that is also cash and cash equivalent only. Right? Even restricted bank accounts are also cash and cash equivalent, people. That's what I'm trying to say. Bank balance in bank account subject to legal restriction. That's fine. Even a restricted bank account is also a cash and cash equivalent. But balance in bank account is fixed deposit. Fixed deposit is not cash and cash equivalent or cash equivalent unless that fixed deposit ka term is less than 3 months. Have they told here fixed deposit ka term is less than 3 months? No. Hence, they asked which is not an example of cash equivalent. B for Bengaluru, fixed deposit is not an example of cash equivalent unless FD ka term is less than 3. If fixed deposit ka term is less than 3, then that will also become a cash and cash equivalent. Okay. Now they said next to MCQ, which are the example of research activity. They have given you various theory question and they're asking which is an example of research. Now we have 2 phases, no, research phase, development phase. Now people design. I'm able to see design and all. You will start the design when when the research is successful. Yes or no? Correct. Design means building something. You will build something only when you have acquired the theoretical knowledge. Otherwise, you will not start. Yes, no? So wherever you see design, that is obviously not research phase. That is development phase. So these options are cut. Remaining is what? B. Searching. Yeah, researching is searching. Acquisition of knowledge phase. Research means that only you acquire knowledge, you search for it from various places. So this is an example of research activity. Okay. So wherever you see design, no, it's not research. So that way automatically the remaining option is B for Bengaluru. That's the right answer. Okay, now people. Now, this writes short notes on IASB. Theoretical you can manage. We'll be doing only new questions here. Huh? Question number 6, same one is there in our class notes, not required. 7 is also a repeat question, not required. 8 also repeat, not required. 9th one is also repeat. Oh, in fact, 8th one maybe. I would just tell one thing. Same question is not there. Similar one is there. But 8th is a cash flow statement. But watch out. Here they have given 31st March 2025, 31st March 2024. So this is your opening balance. This is your closing balance. Goodwill. Goodwill ka opening balance 8 or closing balance 6. 8 has become 6, so it has reduced. So goodwill has been amortized. How much? 2 lakhs. All these numbers are in lakhs. Like depreciation as a non-cash expense, we add, in cash flow statement, indirect method. Here, not only you will add back depreciation, amortization also you will add. Even amortization of intangible asset is also a non-cash expense. So don't forget to add 2 rupees ka goodwill amortization if you're working under indirect method. And here we have to take the P&L from balance sheet. So this will be profit after all adjustments. So dividend also we should add back because current year we have paid dividend of 3 lakh. So dividend also we need to add back. This is a repeat adjustment. This is something you need to watch out. Goodwill amortization. Rest everything is same. You can manage on your own. Question number 9, AS4 ka similar question available. So no need to waste time. Question number 10, I think it's one of the attempt ka previous attempt ka MTP. So again asked over here. I'll do it because here there's a small mistake ICAI has done, I think, in the solution. So I'll give my thoughts on this. Okay, so we will go through question number 10. Construction contract ka question. On 1st April 2024, beginning of the year, Y Limited purchased an industrial plot of land. They purchased a land for 50 lakh for constructing a factory. For factory construction, they purchased the land. Okay, fair enough. This cost of 50 lakh include legal cost of 2.5 lakh for the purpose of acquisition. Obviously, there's also a DAC, so you added. This 50 lakh includes this DAC of 2,50,000. It should be included. It is included. So that's okay. The construction of a factory commenced on 1st May. I think, if you just check here, it is basically people, you need to compute the carrying amount of factory, basically borrowing. It's a AS 10 ka, accounting standard 10 ka and accounting standard 7. I don't think so. This is AS 7 question. Looks like AS 10 and AS 16 ka question because there's some borrowing cost also over here. Okay. So basically DAC, they're testing the concept on DAC, directly attributable costs. Okay. Now, you started factory construction only on 1st May. That is important too. Okay. They will tell you later on when did the construction stop because borrowing cost capitalization starts only when there are 3 conditions for you to start the borrowing cost capitalization. One, borrowing cost like interest should be incurred. Then activities, qualifying asset cost should have started, and activities relating to qualifying assets also should have started. The day all these 3 are satisfied, that day only you will start the capitalization. And once the asset is ready to use, you'll stop the capitalization. Here you started on 1st May. You'll have to see when the construction ended, and they will give it somewhere. Now, 1 minute, people. If you read quickly the requirement, so it becomes easy. You are required to compute the carrying amount of the factory. When? On 31st March 2025. Here, people, you started construction on 1st April. Okay, opening data they have given, and maybe various, if you're starting construction means you'll incur various costs, no? That is given. Now, they are asking factory ka closing balance on 31st March. Okay. All right, one by one. Now, is land required to construct a factory? Yes. So it's a DAC. Can we add 50 lakh? Yeah. This 2.5 lakh legal cost is already included. So have you added 50 lakh? Yes, this is added. It can be added. Fair enough. Next, if you just check for construction, they've given various costs. Preparation on leveling of land. If the land is not flat, if it is Humpty Dumpty, if it is like this, can you construct the factory? No. First, you have to level the land, make the surface proper. To make that, we have incurred 160. There's also directly attributable cost. because unless you incur this cost, you cannot construct the factory. So can you add 160? Yes, you can add it. Yes. So all right. Okay, next to is employment cost of construction workers per month. Every month, how much? 58,000. Now people, since they've given per month, check when did the construction stop. The construction got completed by 31st December here given. You started on 1st May, it got completed on 31st December. Okay, started on 1st May and completed on 31st December. So how many months? May, June, July, August, September, October, November, December. How many months? 8 months. So 8 months construction went on. So you hired some laborers for the construction workers. How much you paid every month? 58,000. 58,000 for 1 month. For 8 months, how much? 464. If you want to construct the factory, you need material, labors and all. All these are directly attributable cost. DAC. Can we add? Yes. 464 we can add it. Next, what else we have? We have purchase of raw material. Material we need. Without material we can't construct. So 42 lakh 48,000 material cost we can add. Next to, we had already studied, right? Few costs will be excluded, like general administrative overhead, relocation cost, any marketing cost, promotion cost, inauguration cost, abnormal loss. All this will not be capitalized but go to P&L. Here relocation cost 75 P&L. Inauguration cost, I don't even have to read. The moment they say inauguration cost, obviously, 1 minute. Okay, pen is not writing. Charge went off, I think here. Just 1 minute. I'll try to take the screen off and come once again. Just 1 minute, people. Charge went off, I think. Pen also is bold. Okay. Let's see if it works now. Now back. I think screen is also back. Okay, everything back. Continue. Relocation cost goes off to SPL. Inauguration cost also goes off. Any marketing expenditure, promotion expenditure goes off to P&L. Overhead costs, people, general overhead costs we transferred to P&L. But here check, they said overhead cost incurred directly to the construction. They said this overhead cost, usually it's not related to a specific activity. It's a general cost. So we transfer it to P&L. But in this problem, they specifically told overhead cost is directly related to construction. Since it is directly related to construction, in this problem, it becomes a DAC. And they told per month overhead cost is 50,000. For 1 month, 50,000, construction period is 8 months. So for 8 months, it will be 4 lakh. If this word directly was not there, we would have transferred this overhead cost to P&L. Because they use the word directly, it becomes a DAC. So 4 lakh can be add? Yes, 4 lakh overhead cost also we can add. That is sorted. Okay, next what is given now? Next few other costs too. Construction got completed on 31st December, fair enough. Production will commence on 1st February. That is put to use. That is irrelevant for us. The moment the asset is ready to use, depreciation also starts. Put to use, irrelevant. That means current year May you have to charge depreciation. Since the factory is completed by 31st December, it is ready to use by 31st December. So January, February, March, 3 months, current year we have to depreciate this factory. The overall useful life of the factory is 40 years. However, it is estimated that the roof will have to be replaced after 20 years. This is what we call it as component accounting. Factory ka life is 40, but in that factory there is a roof. That roof will not come for 40 years. It has to be replaced after 20 years. So if different component of the same PP, if it has different useful life, we have to calculate depreciation separately. I had given you an example of battery and car example, electric car ka battery example in regular class, if you remember. Okay, roof ka life is 20. So roof we will depreciate over 20 years. Other parts of the factory you will depreciate over 40 years. The cost of replacing the roof will be 25% of the total cost. So whatever total cost is there, 25% they are saying relates to roof. Construction of the factory was financed by a loan of 56 lakh. This because to construct the factory you have taken a loan. So it's a factory. So I think so the construction period is 10 months. Ideally we take 12 months to be a substantial period of time and for qualifying asset purpose. But here we will check. We have taken a loan of 56 lakh from 1st April. That's fine. But construction started only on 1st May. So we can't start borrowing cost from 1st April. Though the borrowing cost starts on 1st April, expenditure on qualifying asset is starting only from 1st May. So capitalization rate will start from 1st May, construction period only. From May to here, May to December. That's only for those 8 months. If at all it's considered as qualifying asset, borrowing cost again capitalized. During the period when loan proceeds had been fully utilized to finance construction, Y earned an income of 50,000 from temporary investment of proceeds. Loan, no, they have taken. But do you think entire loan of 56 lakh will be used for construction in one shot? No, in installment. So instead of keeping this 56 lakh loan money idle, they've invested and earned some temporary investment income. In the previous case, they had let out land and earned loan alone. Here, loan itself has been invested and earned temporary investment of 50,000. So this is a temporary investment income you need to reduce. Okay. Assume that net finance cost should be allocated to the factory. Interest cost, they are saying, should be capitalized for 8 months. They only told that 8 months. That means indirectly problem is saying 8 months is a substantial period of time here. So they are asking us to assume factory is a qualifying asset and asking us to capitalize the borrowing cost. So capitalize how much? 56 lakh loan at 9% for how many months? 8 months. So 3,36,000. Entire 336 capitalize. No, there is a temporary investment income of 50. Reduce that. So net borrowing cost will be 286. Okay. Here ICAI has done a mistake. They have taken 9 months. Why 9 months? They started counting from April because you took the loan from April. No? But they forgot that though the loan starts on 1st April, though the borrowing cost starts on 1st April, expenditure on qualifying asset is only starting on 1st May. So April month's ka borrowing cost you cannot capitalize. AS 16 does not permit that. The day all the 3 conditions are satisfied, that day only you can start capitalization. So hence they have taken 9 months. They have counted from April to December and taken 9 months. That is wrong. So and here also it is mentioned that 8 months. So that's a typo. Hence you take the same one only, which is 8 months only for borrowing cost. But don't forget to reduce this temporary investment income. 286 borrowing cost also you can capitalize. Capitalize 336 and 50. If you want net, you can show 286. These two you can net off and show 286, or you can show it separately, your call. Okay, so this is your carrying amount of the factory on 31st December 20x4 when the asset was ready to use. But they did not ask the factory ka carrying amount on 31st December. They asked factory ka carrying amount on 31st March 2025. Construction got completed on 31st December 2024. They asked the carrying amount on 31st March 2025, 3 months later. So you'll have to depreciate the asset. But here there is component accounting also, because there is roof 20 years life, others 40 years life. But before that, this particular number 1 crore 5 lakh, whatever you got by adding all this is for land and a factory put together. Land, do you depreciate? Land is not a depreciable asset, but this 1 crore 5 lakh includes land cost of 50. Eliminate that, because now we are calculating depreciation. Land we will not depreciate. So from this, reduce the land ka amount. Land ka amount is how much? 50 lakh. So remove from 1 crore 5 lakh 58,000. Land ka 50 lakh if you remove. So the depreciable amount will only be 55 lakh 58,000. Only this much you will depreciate. Okay. Now straight away can we calculate depreciation on this amount? No, because there is roof 20 years life, others 40 years life. How much does a roof cost? They told roughly roof constitute 25% of the total cost. Right now. So first find the roof cost. In this portion, how much is the roof related carrying amount? 55 lakh 58,000 ka 25%. This 25% is given to us in the question. I'm calling this as B. So B ka 25% if you do, you'll get carrying amount of roof. From this, if roof ka carrying amount is this, means balance will be others ka carrying amount. All these are carrying amount on 31st December. Now depreciate it for 3 months and you'll get carrying amount at the end of the year. So depreciation on roof will be carrying amount is this, salvage value not given, divided by life 20 years. If you do this, you'll get depre for whole year. But here in this problem, asset got ready by December 2024 and year is ending on 31st March 2025. So in the current year, we'll depreciate only from January, February, March, 3 months. Calculate, that's a depre on roof. What about on others? This is the carrying amount, salvage value not given, 0. Divided by life is 40 years. If you do this, you'll get full year ka depre. Current year, only 3 months ka depre. So that's your depre. Adding these two, you'll get the total depreciation. Okay, so the total carrying amount including the land is this much you have depreciated. So these two, if you minus, you will get the carrying amount of factory at the end of the year. Okay, people, don't take this amount and reduce this. Even to construct a factory, even land is also required. No, so when they say carrying amount of the factory, land also will be included. But land should not be depreciated. So for depreciation purpose, first we'll eliminate the land. Okay, then calculate the depreciation. Take the carrying amount of the factory including land before depreciation, reduce depreciation and you'll get the carrying amount. Okay, people. Now since ICAI took this as 9 by 12, the answers will not match. Our answers, their answers will not match. Rest other things will match. Only here this will change. Since this changed, all other data also will invariably change. So that's the thing about this particular question number 10. Easy question, manageable, aram se. 9th to 11th and 12th rather are repeat questions, nothing new to learn here. So it's so I'll leave it to you. 13th, 14th, 15th also a repetitive question, people. There's nothing new. Similar question is available. 16th question is in AS 28 ka impairment question. Same question is available in our study material. Again, nothing new. This one was also same only, but okay, no problem. We don't see this exact same question, so I'll quickly do it. AS 29 ka question. Galaxy Limited is in the process of finalizing its accounts for 31st March 2025 and they need your advice. Okay, that's good. We'll give that advice. Galaxy Limited is selling a cosmetic product under the brand name Angel Ante. Oh, but getting the products manufactured from X Limited. Oh, X Limited will manufacture the product and sell it to Galaxy. And Galaxy now will put brand name called Angel and sell it to the customer. Okay, I think it looks like a provision and reimbursement asset wala concept, I think, probably. Okay, it has an understanding with X Limited that if a company becomes liable for any damages or injury or harm to customer, 40% of it will be reimbursed by X. So these two people, X and Galaxy, have an arrangement that if any customer files a case against the Galaxy will pay the customer, but 40% of that money Galaxy will collect from X because X only is manufacturing it. No, so that's the arrangement we have. Okay. Now during the year, a claim of 25 lakh is payable to the customer by Galaxy. Now customer has filed a case against Galaxy, and how much money is payable? 25 lakh. So what should Galaxy do? Since Galaxy has to pay to the customer, we have a present obligation. Provision ka conditions is, they only said it is payable. So for this 25 lakh, Galaxy should make a provision. Correct? That's the only matter. No. The moment Galaxy becomes liable to pay a customer, they will also have a right to receive 40% of that money from X. So we'll have to also record a reimbursement asset. Full amount to 40%. 25 lakh ka 40%, which is 10 lakh. But reimbursement asset, we will only record if it is virtually certain that we have studied. So you'll write one line there. Reimbursement asset also should be recorded provided it is VC. VC means virtually certain. That's all it is over here. Okay. One more case. Galaxy has been sued by one of its competitor for alleging infringement of trademark and penalty of 50 lakh. Some of our competitor has filed a case against us saying we have misused their patent and demanding 50 lakh compensation. Now company has appointed a law firm to defend the case for a fee of 5 lakh. We have hired lawyer. Lawyer is putting us chuna or fees for 5 lakh. 60% of the fees is already paid in advance. Out of this 5 lakh, 60% is already settled. So 5 lakh ka 60%, 3 lakh already paid. Rest 40% would be paid after the finalization of the case. Once the court ka verdict comes, then only we'll pay 40%. There is 70% chance that the penalty may not be imposed. 70% chance penalty may not be imposed. Sir, how much was that penalty amount? 50 lakh. Lawyer is saying there is a 70% chance penalty will not come. That means penalty will not come when we win the case. So this 70% is a chance of winning. If there is 70% chance of winning means there is a 30% chance of losing. So outflow will happen only when we lose the case. So there is a 30% chance of losing the case means this is not a probable obligation. It's a possible obligation. So penalty amount of 50 lakh, we will disclose it as a contingent liability. Okay, that is one. But hang on. How much we have to pay to the lawyer? Totally 5 lakh. In that 60% is already paid. How much is still payable? 40%. 5 lakh ka 40%. How much is that? 2 lakh. Sir, whether you win the case or you don't win the case, lawyer fees though you have to pay, no? So same question is available in our class notes, in fact, if you just check this adjustment. So 5 lakh of 40%, which is still not paid, that though you have to pay. So for 2 lakh, you have to make a provision. Lawyer fee related portion pending amount of 2 lakh, you have to make a provision. This penalty amount, you can disclose it as contingent liability because it is not a probable obligation, but a possible obligation. Okay. All right. Next one is question number 18. It's a preparation of financial statement wala question. Similar question, nothing required, nothing new there. In internal question number 19 is also a repeat question. One adjustment is new, I think. I will take you through that. Loan from directors 4 lakh. Check this. Here, this check. A contingent liability. This is the only new adjustment. Rest everything is repeat. A contingent liability of 1 lakh is payable, which has arisen due to wrong action of one of the director. Due to some of the fault, due to a fault of, wait, leave. Team, 1 minute. Team is doing something. Wait, 1 minute. Not you people. I was addressing the team. not you guys. The team was doing something in the back end, so I was just telling them. Okay, wait. And now, contingent liability of 1 lakh is payable, which has arisen due to wrong action of one of the director. Some director has done something that some fault the director has done. Because of that faulty action, company has to pay 1 lakh rupees. That contingent liability has now become payable. We have to settle. It has become payable means we have not yet paid, but we have to pay. It is not a contingent liability. We have to settle this now. Not yet settled, but we have to pay. Not our fault, not company ka fault. This has come only due to the fault of a director. He has agreed to compensate this loss out of the loan given by him to the company. Now director is Papa, good person. He has accepted his mistake and telling, no worries company. Director is telling the company, anyway, I have given you a loan. Director has given how much loan to the company? 4 lakh. So the director is telling the company, now you don't repay me 4 lakh rupees. Director has given a loan to company means company has to repay the director 4 lakh. No, that director is saying that out of that 4 lakh loan, 1 lakh you adjust and you pay me only 3 lakh. Okay, that's what they say. He has agreed to compensate this loss out of the loan given to him. So that means now we'll not pay 4 lakh to the director, we'll only pay 3 lakh. For the remaining amount of 3 lakh, that 3 lakh, how 3 lakh? 4 lakh minus 1 lakh, which is 3 lakh. Directors have agreed to accept cash payment of 20 and allotment of 1,30,000 shares of 2 each. This is the adjustment. First, people, what has happened here? Currently, loan from director is a liability for the company. It is shown at what value? 4 lakh. But will we pay 4 lakh to the director now? No, 1 lakh we will adjust because of their faulty action. So the loan balance is not 4 lakh now. It has to be brought down to 3. Loan is a liability which has credit balance. How do you reduce it? Debit it. So the journal entry you will pass, first journal entry you will pass is loan to director's account debit 1 lakh. Because from 4 lakh you have to make it to 3 lakh. Hence you have to reduce loan by 1 lakh. So loan account debit, loan to director account debit 1 lakh. Right? But this 1 lakh is a contingent liability we have to pay now. Right? To provision for contingent liability 1 lakh. Okay, sir. This is the entry. Loan got reduced and we have to settle the provision. Hence provision for contingent liability. This is not yet settled. If that settled, maybe we could have written bank, or you could have written provision for contingent liability first. If this amount was settled, or whenever this provision gets settled, the entry will be provision for contingent liability to bank. They told it is still payable in the question. If you read the question, they told it is still payable. So that means this 1 lakh is not settled. So this provision for contingent liability will come in henceforth in our balance sheet for 1 lakh. Whenever it gets settled, the entry will be provision for contingent liability to bank. Correct, people? This is one entry. Now, loan from director ka value initially was 4 lakh. Now you debited by 1 lakh means its balance became 3 lakh. Are you keeping this idle or you settled? You settled. So what is the journal entry? Loan from director's account debit 3 lakh. How did you settle? You paid cash 20. So to cash or bank 20,000. Okay, to cash or bank 20,000. Remaining, you gave 1 lakh. You gave some shares. How many shares we gave? 1,30,000 shares of 2 each. This is not rupees. It's actually typo. 1,30,000 shares of 2 each. 1,30,000 is the number of shares issued. Each ka value 2 rupees. So total value 2,60,000. 1,30,000 into 2, which is 2,60,000. So we have to pay 3 lakh to the director now. We paid 260 in shares, 20 in cash. So total paid is only 280. But we have to pay 3 lakh. What about the balance 20,000? That is sacrifice. This is internal reconstruction problem. Don't worry about that. Don't forget that. So balance 20,000 is the sacrifice portion which goes off to reconstruction account or capital reduction account. That's all is a fitting over here. This is the only new adjustment. Rest everything is same. Okay. Yes, people. That's it. Then what else is there? Question number 20 is also not required because same question is available as TYK 10 in our class notes. It's an alignment error here. Expense should be 12,000. Goods sent from head office should be 2,25,000. Typo. Okay. The alignment error. So take this value. Same question is available as test your knowledge question 10 in our class notes as well as study material. Yes, people. So that's all the new questions I could find in this particular RTP, people. Pretty much easy RTP, hardly anything much there. Okay. So yeah, 1 or 2 adjustments was there, which we have covered. So wish you all the very best for your examination. Give your best. Keep yourself calm. Hang in there. So let's see how it goes. Yeah. So take care, people. Bye-bye.